Welcome to XM.com for today's market comment by Mario Setikyriakos. I'm Christina Marujos. Global markets breathed a sigh of relief yesterday as the furious rally in U.S. yields finally lost some steam. The yield on the 10-year Treasury briefly topped the 5% region, sending shivers down the spine of riskier assets such as equities, but got rejected and eventually closed the session much lower, around 4.85%. It seems that U.S. debt with annual returns of 5% was enough to entice investors back into the bond market, and some gloomy economic commentary from two famous investors added fuel to the buying spree. Bonds are considered safe assets that perform well in recessionary environments, so these warnings helped spark some demand, dragging yields back down. With yields on the retreat, the U.S. dollar got hammered as its interest rate advantage was eroded away, pushing the dollar index to its lowest levels in a month. Now, the question is whether this is simply a correction in a broader uptrend for yields, or whether yesterday marked the blow-off top in this rally. Incoming data will probably decide which force gains the upper hand. The drop in yields came as music to the ears of stock markets. The Nasdaq erased a heavy decline to close 0.3% higher instead, as falling yields made bonds less attractive to buy, pushing investors towards riskier plays. Cryptocurrencies shine bright, with Bitcoin rising 13% so far this week, amid bets of an imminent regulatory breakthrough. Gold did not join the party, as it has been unable to record any gains this week, despite the pullback in real yields in the dollar. Gold's inability to rally despite these positive developments is a signal that safe haven demand has started to wane, as markets learn to live with tensions in the Middle East. In a similar fashion, the Japanese yen struggled to advance against the dollar, even amid the retreat in U.S. yields and oil prices. Finally, the euro was the biggest beneficiary from the retreat in the dollar yesterday. The single currency staged an impressive rebound with some help from falling oil prices as well, but the recovery was cut short on Tuesday following some disappointing business surveys. The latest round of PMI surveys warned the Eurozone economy is going from bad to worse, reinforcing concerns that the euro area is headed for a mild recession, which in turn raises the question of how long the European Central Bank can keep interest rates at such high levels. In this sense, the outlook for the euro appears grim, and any euro rallies might be short-lived. Thank you for watching today's market comment here at XM.com.